Hi everyone, welcome back to another video. In this video, I'm going to be giving you all an update on Teladoc. If you can remember, we covered this stock back in March and determined the stock was most likely overvalued based on our 5-year valuation. But back then the stock had dropped around 30% from its high to around about $198 per share. Since then, the stock has continued to struggle and it's now as low as $160 per share. And so whilst tracking our Patreon watch list of covered stocks, I noticed that the stock had sunk to below the estimated fair value that we gave it. And that meant that it's probably a good time to reassess our valuation, see what caused the drop in price, and determine whether TDOC is a good buy at these levels. And by the way, if you haven't checked out that initial video on Teladoc, then go ahead and check it out now because we covered the business model in a lot of detail that we're not going to cover today. We also looked at the recent acquisition of Livongo and some of the total addressable market and factors that will affect their growth. This is going to be more of an update, so if you need some clear information on Teladoc, go and watch that video first. But so if we start with their most recent quarterly earnings and why that shifted the stock price down even further. And it will be good to assess the performance and updated guidance that they gave relative to where we forecasted them to be. So you can see that they managed to grow revenue as expected or even better than expected. Huge top line growth, 150% year over year. One thing I did see though that definitely did spook investors was some analysts saying they had concerns over the membership and visit fee only growth, basically the pay per visit growth. And they're concerned about the growth rate being around 20 to 15%. Naturally, if the platform isn't able to continue monetizing its visits more effectively over time, not now, but over time, then revenue growth will start to correlate or look something similar to the membership growth. And although we haven't seen anything like that at the moment, I mean 150% revenue growth versus 20 to 15% members growth, that's a very big delta, but it's something that analysts have their eye on. I personally feel we're a long way away from that. They've currently got 51 million members, 22 million visitors in the quarter, so that's around 73 million users, and that's quite a considerable amount. So they're not dealing with small numbers here. I think they will be able to make this a more effective platform in terms of its monetization, but at the moment it's about making it a sticky platform that people want to use because it's a practical way to get healthcare services. But I think the real sticking point for some investors is the bottom line. Of course, we're in an all-time low interest rate environment. Couple that with inflation concerns, meaning that interest rates may be forced to rise, and businesses like Teladoc, who give investors no real guidance and confidence as to when they actually expect to produce cash flows and real earnings, they end up losing their present value or the market value. Therefore, the stock drops. But this is all theory. What do the numbers actually say? So their net loss was around 196 million for the first quarter compared to 29 million in the first quarter last year. So the revenues have expanded, yes, but the losses have also expanded. Some would argue even at a quicker rate than the revenue has. That might be concerning to some investors on an Ebitda basis. So you're taking out some of that stock-based compensation and things like that. They actually only lost around 36 million this quarter compared to 11 million in the year before that. Now, okay, this isn't great, but what they do give us here, and you've got to be careful with adjusted figures, all right? But adjusted Ebitda, what this is trying to tell us is, as a business, when we can normalize all of the earnings and taking out all of the non-recurring or supposedly non-recurring items, what sort of margin can this business spit out? And on an adjusted Ebitda basis, they produced 56.6 million for the first quarter versus 10 million for the first quarter of 2020, which is around a 5x improvement. So they're trying to tell us that if they take out all of these restructuring charges that were associated with the Livongo acquisition, and then also take out some of the stock-based compensation which was involved in that as well, and obviously it's a relatively early days company, they will have stock-based compensation. It is a valid cost, but it does start to normalize. Then you could expect somewhere in the region of a 12 to 15% margin for this business. That's what it can spit out on a cash earnings basis, on an Ebitda basis. Now, the next thing that I would like to look at is the guidance and compare this to our forecast that we gave Teladoc and basically led into our valuation. So we can see for the full year 2021, they've actually upped their guidance slightly. So they expect revenue to be in the range of 1.9 billion to around 2 billion. They do like to lowball on guidance. I have seen that with this company. We looked at it in the previous video in some of their guidance for members and things like that. It seemed like really strange guidance that they were giving, nowhere near accurate, or the CEO just doesn't really know the business. So either way, it's not exactly a good sign. Ebitda they expect to be in the range of minus 120 million or minus 100 million, so they expect to make a loss in 2021. I think this was another sticking point for investors, that they're even forecasting for the full year they're going to lose around 5% of revenues. But that adjusted EBITDA number, and again, be careful with adjusted EBITDA, know what's in it, know what they're taking out to get to that number. But in this case, they expect adjusted EBITDA to be in the range of 255 million to 275 million. So on an adjusted basis, they could expect somewhere in the region of a 15% margin. Now, just before we get into the valuation, we did touch on this in the previous video, but why is there a lot of hype around Teladoc and telemedicine? Well, the industry itself has been growing at around 34% since 2014. That's a compound annual growth rate, taking the revenues from 500 million to around 2.5 billion today. The telehealth market is expected to reach 175 billion by 2026. That's a 4x from where it is today. And with Teladoc's business model essentially being a SaaS business model, they're set up perfectly to capitalize on this. They've got a high degree of visibility around revenues, where 80% of it is on a subscription basis. They've also got a 90% retention rate. You couple this with very good gross margin profiles. So 60% to 70% gross margins, that usually suggests they could get the bottom line to around 15 to 20% over time with efficiencies. And so let's cap this off with looking at the valuation. This is exactly the same as the previous valuation we did in the other video. The only difference is that when we did the video, it was at $198 per share. Now it's at $161 per share. So we've seen a fairly significant drop, like I said. Now, this is a company with explosive growth, top line growth, and probably going to see explosive earnings growth as well eventually. Right, 50% CAGR is what we estimated, but it is selling at around 20 times sales. So there's no getting away from the fact that the valuation is quite extreme with Teladoc. Now, looking back at the valuation, there's nothing specifically that I'd want to change too much in terms of the forecast. So the guidance, they actually up guidance ever so slightly. So our guidance is probably going to be spot on to where we had it initially. 90% growth rate that was going into 2021, and then we dropped it down to 50% and then to 30%, getting us to around 7.9 billion of revenue in 2025. We calculated that that should be a fair enough estimate of revenue, because that's around about a 5% market share of the total spend in the telehealth global market. 5% is something realistically I think Teladoc could do. Now, I think everyone knows the main variable that could cause a margin for error in this valuation is going to be the profit margins, or the operating margins. Obviously, this is a company that isn't profitable yet, which makes doing a DCF analysis on it very hard, and actually doesn't make a huge amount of success, but it's the closest that we can get to valuing this company without just taking a guess. So if we go by their adjusted numbers that they had, we saw they had adjusted EBITDA numbers currently of around 12 to 15%. All right, that's the current margin profile. With efficiencies, knowing that they have close to a 70% gross margin, I was expecting they could get close to 20%. All right, I'm hoping they could probably do more than 20%. This is a SaaS business model like we covered, but let's say they can only make 15%. What does that do to our valuation? We can see our fair value there drops to around $182 per share, meaning there's still around 13% upside. Another thing that I looked at that maybe I would want to change, or maybe adjust ever so slightly, is the terminal values. We didn't really know how to value this company 5 years down the line when we initially looked at it. So we went with a mixture between a 30 times earnings multiple and a 10 times EV to sales, because when you don't know what the margin profile might look like, but they have high gross margins, a lot of investors will look at the company from an EV to sales perspective, like they are currently, valuing it at 20 times sales. So we were saying that that premium is going to come down and look more like 10 times sales. If we drop that to 7 times sales, let's see what that does to the valuation. It drops it to around $165 per share. So as you can see, this valuation is sensitive to a number of factors. Like I always say, it depends on what you are absolutely sure on. Can you buy with a significant margin of safety and a lot of room for errors? That's what I like to do, buy where there's a lot of room for error. In this case, if we drop it all the way down to 15% on both a free cash flow and operating margin side, and then drop the EV to sales down to around 7 times, then unfortunately it means it's around 10% overvalued. So what I would say with Teladoc is that if you were looking to buy the company, you're convinced by the business model, you're convinced by the growth of this company, then it's probably a good chance to get in if you haven't already. All right, as you were looking close to the wire, it was a little bit overvalued by my estimations at $198 per share. Now it's dropped to $160. It's still a very rich valuation when you're just looking at static numbers. But if you factor in the growth, if you factor in the size of the industry, 175 billion for the total addressable market and the 5-year compound annual growth rate of 35%, then you can sort of see how you could get to a fair value today. But as I always say, you have to be really convinced by the business, know the business well, know the industry well, and then make an informed decision from there. As always, this is going to be available on the Patreon to download with a load of other valuation models and our watch list tracker that tells us when these stocks are dropping, whether they're approaching the estimated fair value that we gave them. So I'll leave a link in the description below. Go and check that out if you're interested. Leave a like on the video if you got some value out of it today or if you enjoyed it. Subscribe to the channel if you haven't already and leave a comment down below. Let me know what you think of Teladoc. Do you think it's hit fair value now that it's dropped over 45% from its high? I'd be interested to hear all of your opinions. But until next time, good luck with all of your investments.